For decades, the 60-40 portfolio stood as the gold standard of investing: 60% stocks for growth, 40% bonds for stability. This approach wasn't just a trend, it was a time-tested formula that shaped the way generations thought about building wealth and protecting their future. Financial advisors, textbooks, and even family conversations about money often circled back to this simple balanced mix. The beauty of this mix was its elegant simplicity. When stocks soared, you gained; when they stumbled, bonds cushioned the blow, smoothing out the ride for investors. It was a strategy that didn't require constant tinkering or expert timing, just patience and trust in the long-term power of markets. The real magic was in the relationship between stocks and bonds. Historically, when one zigged, the other zagged. This inverse movement helped millions steadily build retirement wealth, providing peace of mind through market ups and downs. In the 90s and early 2000s, investors could almost set it and forget it. The market's long-term upward trend, combined with steady bond income, made the 60-40 portfolio feel almost bulletproof. Families watched their retirement accounts grow, confident that this classic formula would see them through. The strategy became textbook advice, praised for its ability to balance risk and reward. It was taught in classrooms, recommended by professionals, and adopted by pension funds and individual investors alike. Its remarkable success was fueled by decades of falling interest rates, a trend that boosted both stocks and bonds. As rates dropped, bond prices rose, and companies found it easier to borrow and expand, lifting stock markets higher. Lower rates made borrowing cheaper for businesses, encouraging investment and growth. At the same time, the value of existing bonds increased, rewarding investors who held them. This win-win scenario cemented the 60-40 as the all-weather portfolio, a strategy that could weather storms and shine in fair weather alike. But this reliability was built on a unique economic era, one defined by steadily falling rates and predictable market cycles. That era, many experts now say, is behind us. The question now is more pressing than ever: can the 60-40 portfolio still deliver in today's unpredictable world? Or is it time for investors to rethink the old rules? In 2022, the 60-40 portfolio's reputation took a historic hit. For decades, this classic mix of 60% stocks and 40% bonds was considered a gold standard for balanced investing, a reliable formula that weathered countless storms. But suddenly, the unthinkable happened. For the first time in a generation, both stocks and bonds plunged together, blindsiding investors who had trusted in the power of diversification. The financial world watched in disbelief as the two pillars of the traditional portfolio crumbled at the same time. Soaring inflation forced the Federal Reserve to hike interest rates aggressively, sending shockwaves through the markets. Stocks tumbled as borrowing costs soared, and bonds, usually a safe haven, saw their values crushed by the rapid rise in yields. The safety net investors had relied on for decades simply vanished. Bonds, which were supposed to cushion stock losses, failed to provide any protection. The old rules no longer seemed to apply. The result was devastating. Double-digit losses swept through portfolios, and a wave of doubt crashed over the investment community. Suddenly, the old strategy looked dangerously outdated. Suddenly, everyone was asking the same question: is the 60-40 portfolio dead? Financial news outlets, advisors, and everyday investors all debated whether this once trusted approach could survive in a new era. The core belief that bonds would always diversify stocks was shattered. The foundation of modern portfolio theory was shaken, leaving many to wonder if anything was truly safe. The crisis forced a deep rethinking of investment basics. Was the old model still relevant, or was it time to build something new? Investors and advisors alike began to question long-held assumptions and search for new answers. Even after a recovery in 2023 and 2024, the scars of 2022 remain. The shock of that year lingers in the minds of investors, serving as a stark reminder that no strategy is immune to change. The era of falling interest rates is over, replaced by persistent inflation and unpredictable policy shifts. Investors now face a world where the old playbook may no longer work. Investors learned the hard way that true diversification means more than just mixing stocks and bonds. It requires a broader approach, one that can withstand shocks from any direction. In the wrong conditions, even opposites can fall together. The events of 2022 proved that nothing in investing is guaranteed, and that confidence must be earned, not assumed. Beyond market shocks, a bigger force is quietly transforming the way we invest: People are living much longer than ever before. Advances in medicine, nutrition, and technology mean that reaching your 80s or even 90s is increasingly common, and many of us can expect to spend decades in retirement. Financial planners now recommend preparing for a retirement that could last 30, 40, or even more years. This is a dramatic shift from previous generations, who often only needed to plan for a decade or two after leaving the workforce. With this extended timeline, your nest egg must stretch much further, and it must also cover the rising costs of living, especially healthcare, which continues to outpace inflation. In fact, a healthy retired couple in 2024 may need to set aside over $300,000 just to pay for medical expenses throughout retirement. This figure doesn't even include long-term care or unexpected emergencies. While medical advances are helping us live longer, they also mean more years of potentially expensive treatments, medications, and specialized care. The traditional 60-40 portfolio, once the gold standard for retirees, was designed for much shorter retirements, not for decades of steady withdrawals and rising expenses. Its conservative approach may not generate enough growth to keep up with inflation, taxes, and the ever-increasing costs of healthcare and daily living. If your investments don't grow faster than your withdrawals, you could face the very real risk of running out of money in your later years, just when you need it most. That's why today's retirees must focus on growth, not just preservation. Building a portfolio that can outpace inflation and support a longer life is more important than ever. The old model is quickly becoming obsolete. A new, more dynamic approach is needed to meet the challenges of a longer, more expensive future. Ultimately, the biggest threat facing retirees today isn't just market volatility, it's the possibility of outliving your savings. Planning for longevity is now the most critical part of any retirement strategy. To fund longer retirements, experts now recommend more stocks, even for retirees. Portfolios with 70% or 80% equities are becoming the new norm. The goal: outpace inflation and ensure your money lasts. Yes, stocks bring more volatility, but the bigger risk is running out of money. Diversification within stocks, US, international, large, small, growth, value, is key. This shift requires a new mindset, tolerating more ups and downs for long-term growth. The comfort of a bond-heavy portfolio may be an illusion in a world of rising costs. In 2025, embracing more equities is essential for lasting financial security. But stocks and bonds alone aren't enough anymore. Enter alternatives, assets that behave differently, and add a third leg to your portfolio. The 50-30-20 model, 50% stocks, 30% bonds, 20% alternatives, is gaining traction. Managed futures and market-neutral funds can deliver gains when traditional assets fall. Infrastructure funds offer stable, inflation-linked income. Alternatives diversify risk and provide new sources of return. They're more complex and often pricier, so use them strategically. In a world where the old rules failed, alternatives are now essential. They help manage risk, fight inflation, and build a more resilient portfolio. Among alternatives, gold and real estate stand out as time-tested protectors. Gold shines in crises, often rising when stocks fall, just as it did in 2025. A small gold allocation can act as portfolio insurance. Real estate, especially through REITs, offers steady income and inflation protection. As rents rise with inflation, so does real estate's value. Together, gold and real estate address the weaknesses of the old 60-40 mix. Today, it's easier than ever to add them via ETFs. By including these tangible assets, investors build a stronger, more diversified foundation. The evolved portfolio isn't abandoning diversification, it's enhancing it. Bonds aren't dead, they're evolving. Investors now demand more precision and predictability from fixed income. Bond ladder ETFs are a modern solution, offering defined maturities and steady income. These funds reduce interest rate risk and provide tax-efficient payouts. Unlike traditional bond funds, they return principal at maturity, offering clarity and control. With rates above 4% in 2025, locking in yields with bond ladders makes sense. This approach restores bonds' role as a stable anchor and cash flow source. The bond allocation is smarter, more transparent, and better suited to today's uncertainty. Fixed income isn't gone, it's just getting an upgrade. Modern portfolios must look beyond U.S. borders. In 2025, international stocks are outperforming, boosted by a weaker dollar. Global diversification is now a necessity, not a luxury. Spreading equity across developed and emerging markets smooths returns and reduces risk. Some investors are also making tactical shifts, adjusting allocations based on market signals like treasury yields. When yields are low, tilt toward stocks. When high, shift to bonds. Adjusting bond duration, favoring short-term bonds in rising rate environments, can also reduce risk. These tweaks don't abandon the 60-40 model. They make it more adaptive. The key is flexibility. Respond to changing conditions, don't just set and forget. The new balanced portfolio is global, tactical and responsive. The 60-40 portfolio isn't dead, but it must evolve. The world has changed. Longer lives, higher costs, and less reliable asset relationships. Diversification is more important than ever, but it must be smarter and broader. The modern portfolio starts with more global stocks for growth. It adds alternatives like gold, real estate, and managed futures for resilience. Bonds are upgraded with tools like bond ladder ETFs for stability and income. This multi-asset approach creates more sources of return and protection. The future is about customization, tailoring your mix to your needs and the new realities. Don't abandon diversification, expand your definition of it. Build a portfolio that grows and protects your wealth for the decades ahead.